know if it drives you crazy that I sip espresso.
Welcome, your valued CPA listeners. Hello, hello. Today we have an awesome treat for you. Today we are here with Jonathan Cardella with Strike Advisory, and he is going to bring the sexy back into R&D credits for businesses, and he's going to tell you exactly what you're missing in your business, how easy it is to evaluate, and he's going to make it such a no-brainer that everyone's going to be calling him up right after this to make sure that your business qualifies. Jonathan, hello, hello.
Hello, good morning.
Good
Or shall
morning.
I say good afternoon in your part of the world?
I mean, it's 5 o'clock somewhere, right?
Exactly.
5 o'clock somewhere. And so funny because we were just chatting before this, and you gave me the most extraordinary um, analysis of Strike Advisory and what you do and how you came up with it. Do you think you can replicate it now when it actually matters to our audience?
That's a lot of pressure. What I was saying was that my background is 26 years in performing R&D, and about 8 years ago, 9 years ago, after the TCJA passed and kind of removed most of the AMT implications, where you could now drive your tax rate down effectively to zero, I was awakened to the R&D tax credit as a terrific opportunity for companies to save and to reduce their effective tax rate. And so while I was running my software company and learning, about the credit, I realized that there weren't very many good alternatives out there, and I started Strike specifically with the goal of offering a multidisciplinary sort of approach to maximizing credits for business owners and taxpayers by approaching the problem not just from an accounting standpoint, but from the engineer standpoint, the technologist standpoint, the legal standpoint, in terms of engaging attorneys, accountants, and technologists to come in and analyze the work that a company is conducting to truly understand the work being done and to maximize their credits using, that approach, that multidisciplinary approach that I
So,
saw lacking in the marketplace.
and I love that you're saying that because essentially what you just said, you're a complete R&D nerd and you can save
Totally.
people a lot of money. So let's bring it
Yes.
down a level. But also, so in a few moments, we're gonna make sure you understand why this is so important to you. And in a few moments, we're gonna go into why a lot of business owners fail to qualify for their research and development credits with other firms. And in a moment, we're also going to talk about why Jonathan's creative approach and his multidisciplinary approach really benefits you. And just going back to the basics, because as a CPA, I myself, I know what R&D is, it's research and development. However, even with professionals such as myself, it's still very difficult to figure out what research and development is. So can you just give us like a broad definition without going any further and then let's
Yeah.
take it from there. Like the
Yeah,
most
absolutely.
basic,
Well,
like I'm a 5-year-old.
absolutely. So most people think R&D means you got to have a lab coat and you have to be publishing findings, and no one thinks they qualify. So a big part of our jobs is to convince business owners, by the way, you're actually conducting R&D. And even though you've been, your CPA doesn't realize it because that's not what they do. And even though you may think you don't, in fact, you do. And this is a credit that's been around since 1981. And this is how, major corporations, billionaires are paying 5% and less in taxes is because they're taking advantage of credits like this. And this is one of the primary methods. The major tax consultancies and accounting firms like the Big Four that traditionally do this credit pretty much ignore the small businesses because they've got big fees and they're working on Fortune 500, and their model doesn't really scale to these small businesses. So when we entered the market, our whole idea was to really democratize the credit and bring it to the small business owner. So effectively, what is the credit? Let me answer that question.
Yes. What
The
is a
credit,
credit versus
yeah,
what is a reduction in
yeah,
taxable income? That's the biggie right here.
sure,
Well, I'll let you take over.
definitely. So everybody takes deductions, and sure, you can deduct your R&D related expenses. but a credit is in addition to a deduction. A credit is a dollar for dollar offset for federal and or state income tax. Credits are refundable on two levels. The first level meaning that if you pay taxes in the past, because there's a retroactivity to it, you can look back at least 3 years. You can actually generate refunds from the taxes you paid in the past. So you can, it's not just a credit, but when a credit is used on an amended return, it generates a cash refund. A credit can also be used in the present tax year to offset or reduce your current year of taxes if it's a timely credit. But what is
So,
the what is R&D though? I think was the question you asked that I haven't answered yet. And what I was saying is that there's a big misconception. Everybody thinks it's lab coat work and you have to have scientists or licensed engineers and they have to be publishing research findings. And that's not the case at all. Anytime a company is producing a product, a process, whether they're producing software or a widget or whether they're manufacturing, on some level, typically science or engineering comes into play. Their staff may not be licensed science, engineers. They may not have science degrees.
okay.
But when you produce software, for example, you're performing software engineering. When you, use CAD to draw a design to architect something or to design something, when you're tooling a manufacturing line, you are using these disciplines, and that's one of the first things that we're looking for is somebody in the U.S. doing something technical to produce a product or service or deliver a product or service or to attempt to deliver a product or service for commercialization, meaning to make money. If those answers are yes, then we dig a little bit deeper and say, was there sort of can we make the argument, can we ascertain whether or not there was actually some sort of structured process on some level for eliminating the technical uncertainty required to produce that product or service? And almost always the answer is yes. It's as little as trial and error, right? I designed something. I looked at the design. I tested the design. It failed. I tweaked it. I did it
Yeah.
again. I wrote some code. I tried to run it. It failed. I edited it. I ran it again. These are methods of trial and error. That's a key
Trial and error.
indication that somebody's doing R&D. If there's
Okay.
trial and error or researching alternative methods, I tried A, I tried B, it looked a little better. B looked a little bit better. Maybe I'm in agriculture and I have different seeds with different genetics, and I'm measuring how pest resistant they are. And I'm taking notes as I try different, genetics, different techniques of fertilizing and watering that plant with the different genetics. And I'm looking at yields, and I might be recording that. And I'm trying different methods. And over time, I'm driving up my yield, or maybe I'm even failing. It doesn't matter. So long as I have documentation that I can prove that I spent money in this process, regardless of whether I was successful or not, the wages, the supply costs that go into that sort of work, if documented properly, can all qualify for substantial credits to reduce a business's or an individual's income. Because remember, if they're
Jonathan,
a pass-through entity,
that's
the
significant.
credits flow through to the person, to the individual owners. And if
Yeah.
it's a C corp, for example, then it would reduce the company's taxation and thereby increasing distributions to the shareholders,
Okay,
in
I'm
theory.
swimming in a lot of knowledge. So let me, based on what you just said, so let me just break this up a little bit. I want to go back to something that you had said earlier, and you said you can take a credit in addition to the deduction. Does this apply to research and development? If clients have previously, they didn't know that they qualified or may potentially qualify for an R&D credit, can they expense everything that they've expensed in the past and in addition then take the credit? How does that work?
Absolutely. Absolutely. I mean, technically, the credit gets added back so that it essentially reduces the deduction sum, but you can still take your deductions and your credits together. And the credits with the deductions is almost always a better outcome for you than taking only the deduction.
That's very interesting. So if, let's say we were retroing something back for the credit, would we have to make adjustments in the deductions or were those
Poten-
deductions 100% taken?
Potentially, we might have to add the credits to income,
Okay.
which would effectively reduce the deductions, or we can make a 280C election in which we treat it a bit differently. And we're getting a little bit
Technical.
technical, so I don't know if that's going to be the way to go about it. But effectively, what I think a business owner should know is that
Yes.
if you're only taking the deduction, you're leaving a ton of money on the table.
Thank you.
Um, so with a 280C election, the taxpayer would get a double benefit, the full deduction for R&D expenses and the credit based on those same expenses. But you
Awesome.
have to elect the 280C. If you don't elect the 280C, you just add the credit to income. You still get your deductions, but you have more income, but the credit's more than offset by a significant amount, the additional income that the credit represents.
I love that. So I'm gonna pause you right there. Research and development R&D is an extraordinarily complex method to get the desired result of what the best credits and the best deductions for an individual is, or business, excuse me, for the current year and past years, right? And can you carry this credit forward?
Yes, federally you can carry forward 20 years.
It's a trifecta. It's a whole
So
trifecta effect.
if you can't use it all now, you can use it. Then about 38 states have state credits. They all have different carry forward periods, and they range anywhere from 5 to indefinitely, or 5 years to indefinitely.
I love
So you're
that.
offsetting your state and your federal income taxes if you're in a state that has income tax.
I absolutely love that. And if anyone drops off
And
here,
technically,
although I want everybody to stay, obviously, but if anybody drops off here, know that you can take it in the current year, you can take it back 3 years, and you can take it forward. And some states also have the credit. So it's really a no-brainer for any business to see if they would qualify for this credit. Can I ask you a question?
yes,
Uh,
absolutely. Sure.
What did the big beautiful bill changed a few things with respect to the R&D credit? How, and I always tell everybody that beauty's in the eye of the beholder, right? Beauty's in the eye of the beholder, same with the big beautiful bill. There's some limits and maybe some people may grumble about, but all in all, it has produced extraordinary tax benefits to business owners and individuals. How does that apply to the R&D credit market?
Yes, had major implications for the R&D tax credit. Um, the first thing I would say is that the TCJA had, to understand the full impact of the One Big Beautiful Bill, you have to kind of understand the history a little bit. And in 2017, I think it was, the TCJA passed, and in general, it reduced taxes for a lot of entities and folks, but it had to be offset of balancing the expense of the bill. And the way they offset it was that the TCJA had a little, what I'll call an Easter egg, a trigger that in 22 went into effect. And what it did was the TCJA actually had a kind of a very negative impact. It was kind of like an innovation tax that triggered in 22. And it made it so that you had to amortize your R&D expenses starting in 22 over a 5 year period.
Yep.
Um, and a lot of companies stopped doing R&D or taking the R&D tax credit as a result because, in theory, if you amortize over a 5, 6 year period, it should all even out if you're doing the same amount of R&D. But for a small business, it effectively reduced their deductions. You can only take about 10% in the first year and 20% each year thereafter of your R&D expenses in the current year. So it just really reduced the deductions that you got for R&D. Um, Prior to the One Big Beautiful Bill. So in 22, 23, and 24, companies were really taxed heavily, essentially, for doing R&D, which was unfortunate. And, and the implication of that is that, like I said, companies stopped doing R&D, they stopped taking the credit because they lost their deductions. And when you lose your deductions, essentially on paper, your income goes up, even when you don't necessarily have net income because you had the expenses. You just weren't allowed to apply them as deductions, which was crazy.
Which
I
is
mean, we were
crazy.
literally
Which left a bad
disincenting
taste in people's mouths
innovation.
with the whole credit itself. But it
Horrible. So they
wasn't the
stopped taking the
credit's fault.
credit.
Yeah.
It wasn't the credit's fault. The credit
No.
was still a good credit.
Yes.
But the problem was you were losing your deductions. And so all of a sudden, I'm not doing R&D. I'm not taking the credit. I'm not, we're not doing R&D anymore was the position of business owners. And as a result, a lot of these companies didn't take the credit in 22, 23, and 24. Some companies continued to do R&D and did capitalize and amortize the expense. So in the first year, you start at the midpoint. You only get 10% of your R&D expenses. And they paid, they lost their deductions. And if they had significant revenue, they may have been paying income tax on profit that they really didn't realize, so to speak. Sure, it was on the balance sheet as an asset, but when you build an R&D asset, it may have no value. It's a theoretical value, effectively, which is the non-expense or non-deducted portion, right?
Yeah.
So it was really harmful to companies in a lot of ways. It was just an awful innovation tax. And the one big beautiful bill that passed back in July reversed that treat. So 174, it always allowed you to choose, did you want to take it in the present year, all of your R&D
Mhm.
deductions, or did you want to space it out over 5 years? That was how it was since the 1950s. It gave the taxpayer a choice, and that choice was really nice because if you were pre-revenue or generating a little bit of revenue, you may want to amortize it and
Yeah,
save the expenses for the future when you
exactly.
plan to be profitable. That's why you're in business. So it was great. And if you were generating a lot of revenue, or a significant amount, you would want to take it in the present year so that you had the deduction and you didn't have the income tax. So that right went away, and you were supposed to amortize no matter what, meaning only take a small portion of the deduction and capitalize the rest of the R&D on your balance sheet as an asset. And so
Mhm.
the one big beautiful bill restored 174 to the way it has always been prior to 22 and gave the
Awesome.
taxpayer back that option for domestic expenses. For foreign expenses, it still left it changed where you now had to amortize over 15 years. So if you have offshore developers, that sort of a thing, you're actually supposed to amortize those expenses over 15 years. And it makes sense because, the administration wants to keep jobs here. So it sort of evens the playing field a little bit in that you may pay less wages offshore, but you get almost no deduction each year. You got to space it out over 15 years. Whereas a domestic R&D expense can now again be completely expensed in the current year. But the one big beautiful bill went a step further, and it added retroactivity to the 174 treatment, meaning that the taxpayer could now the taxpayer now is able to um, opt, if they're under $31 million in revenue, they can opt to go back and amend and elect to reverse that amortization and essentially take all the expenses in the present year, amend their returns, restate their financials, and reverse the amortization, thus generating refunds just by the reversal of amortization.
Mhm.
Additionally, it gave the incentive to the taxpayer who didn't take the credit in 22, 23, and 24 to go back and amend and actually take the credits. So if you amortized, you can now reverse the amortization. If you didn't amortize and didn't take the credit, you can go back and take the credit, and you don't need to amortize. You're retroactively blessed, effectively.
That's
You're
amazing.
compliant. You're
That
compliant now, even if you weren't.
that's
So it was a
amazing.
really big win. But if you were over 31 million in revenue, you can still elect to change the treatment, but you're not allowed to amend 22, 23, and 24 in that way. Instead, you can accelerate the depreciation from those years in 25 and 26, effectively taking all those expenses in 25 and 26 if you'd like, to minimize those years.
Yeah, I love that. I love that. And thank you because we really did need to hear the history of what TCJA did and 2022 and then how July 4th, 2024 changed this. So once again, it's not that the credit was bad. The credit was always amazing. And the credit always gave a lot of benefit to the business owner and its shareholders or partners. It's just the way the tax code was written, it actually penalized people who were innovative. Whereas right now, if you didn't qualify before, or if you didn't want to jump through the hoops because it just didn't seem as sexy or attractive anymore, then now is the time to look at that again. Now, I did hear a little bit that there's some sort of deadline of June or July 2026. Can you tell us about that and why is that
Yeah.
important to act
The bill
now?
passed on July 4th, but I think July 6th is the first business day
Hmm.
after the holiday. So between now and July 6th, July 4th, to be careful, if you want to be conservative, you have to make an election to, if you're under 31 million, uh, going back and unwinding that amortization in order to generate amortization requirement. You had a lot of tax in 22, 23 because you did amortize. So long as you elect by July 4th or 6th of this year, you can go back and unwind it and generate refunds, which is
So,
huge. And if
Jonathan,
you're over
repeat
30
that whole
million,
thing one more time. You broke in and out a little bit, and I don't want
sorry about that.
anyone to miss a beat here.
Sure. You can go back and elect between now and July 4th, maybe July 6th, technically. You can go back and
2026.
2026,
Yep.
you have an opportunity to go back and essentially, if you did amortize your R&D, your domestic R&D, you can go back and unwind that amortization. And so
Okay.
if you lost those deductions and paid a lot of tax, you can go back and take the deductions now, amend your returns, and
Unwind or amortization. Yes. All right,
generate
perfect.
massive cash refunds. That opportunity goes away by July 7th.
Does a business owner, Jonathan, does a
If
business
you're
owner need you to do that, or can their tax preparer do that for them to make that election?
the technically the yeah, it's should be able to do that.
Okay, so you're saying the tax preparer should be able to do that, but what, so when
Sorry,
is
I
the
don't know.
best? Go ahead.
Our connection is a little bit shaky. I don't know if it's on your end or my end. I could change my Wi-Fi networks to see. I'm so sorry. I haven't
You're
had this
good.
problem before
That's okay.
recently. I'm gonna switch Wi-Fi. I'm gonna switch.
All right, awesome.
Still connecting. Testing, testing. Sorry.
All right, we'll cut this part out. We'll cut this
We
part
got
out.
it. Sorry, I know you prefer not to edit, but I think maybe my network had some interference and this one's better. I had two networks, so I just switched and
So don't
I'm
start
happy.
yet. Let's make it, let's test it, chat for a few brief seconds so that it'll be very clear where we're restarting it.
Yeah, I think it's way better. I think it was on my side and I think it's way better now.
Oh, you're
I'm not losing.
actually, yeah, your bars by your name are good now. Okay, you're good on your end?
I am so good now.
So
So
after I say like cut here, then go back to why the tax credit is do you remember where you left off?
yeah, what I was saying was that the taxpayer needs to make an
Okay,
election.
hold. Okay. So, all right. Lorena, cut it here. Go ahead.
What I was saying was that the taxpayer needs to make an election by before July 6th or by July 6th of 2026, in order to go back and unwind the amortization they did to take those deductions in 22, 23, and 24, especially if they paid significant taxes in those years because they lost their R&D deduction in order to generate cash refunds for those years for the taxes that they paid, since now effectively they've overpaid their taxes if they make this election. If the company generates over 31 million in annual revenue, and it's a gross receipts test, it's like the average over the last 3 years. If they're over 31 million, they can make an election in order to accelerate the depreciation of those assets in 25 or 26, or a combination of the years as it benefits them.
I love that. This is just one of those no-brainer for clients. So let me then take you through a few situations that I've personally experienced over the last year. We have referred some clients out to get R&D analysis done to see if they would qualify. And the few creative ones that we thought would work got rejected by certain R&D companies. I won't mention any names or anything like that, but I feel like they weren't as creative maybe. And your multidisciplinary approach, I think, adds value. And I won't mention the clients' names, but there's two very specific ones that I'm thinking about, and I believe they would qualify for something extraordinary. Number one is they're doing a lot of research and development, truly, in digital products. They're digitizing them, they're selling them, they're downloading them, they're copywriting them, and they have their own unique process. And I was flabbergasted when they got denied by one R&D company. I had said, "Hey, don't get discouraged. I think I have someone else for you to talk to, so that we can see, so you can get a second opinion."
I
So
think
that
that's smart. It is. I mean, honestly, a lot of these companies, these big name companies, they send you an associate. The associate's kind of trained a bit like a robot to look for certain things, and that's it.
that's
I
what I
think
thought.
without really truly understanding the way the company's working and the work they're doing, it's really hard to know to qualify or disqualify until you get pretty deep in. But if it doesn't look lucrative enough, if it doesn't look like a sure shot, a company, a provider may not want to invest the time and effort. Some companies charge hourly, but some do it on a success fee basis.
Yeah.
So a lot of the staff have been trained. If the chances of success don't look great up front, just weed them out, right? Now that's pretty painful to the taxpayer, of course, if they miss out on a big credit. But that client sounds like they're involved in software engineering on some level. The easiest way, the biggest clue is, do you have W-2 or 1099, right? Do you have in-house, W-2 staff, salaried staff, or do you have contractors or a relationship with an outside company in the US
Yeah.
that's doing, in that case, some kind of software development, web development, software engineering? Do you have wages or 1099 expenses in that respect? And if so, that's a pretty good indicator
Hmm.
that there's a decent chance you're doing R&D. There's a bit more to it than that, of course.
Yeah.
Understanding, for example, if you're doing it as funded research, like if somebody's paying you to do it on a time materials basis, then it's probably their R&D and not yours.
You got it.
Because as a taxpayer, you got to take some risk and you have to kind of own the fruits of the research, right? So if it's your software, your solution that you're going to own as a taxpayer, and it's your staff, you're taking the risk, you're going to own the rewards, the upside, the knowledge from the work being done, then it's probably your credit, there's a very good chance you qualify.
Yeah, that's interesting. I'm gonna send them your way. And then if they do qualify, I'd love to do a follow-up podcast on like, okay, this is what the other company said, this is what you said, and this is how you can potentially qualify. If you'd be open to that. I have another one that also now this is interesting because I have a lot of clients in this person's bucket where they're utilizing all the socials and the marketing aspects, but they're making the process of their own and they're uniquely qualifying the process as their own. And I thought that maybe there would be something there that generates leads, creates sales, and it's not a proprietary software per se. I think they're using a bunch of different things that are available, but making it proprietary for themselves. And it's been generating a lot of lucrative revenue over the last several years for them. And they
Sounds
also
like it
got
has
declined.
potential. Yeah, it doesn't have to be, it could be a product, a process. So you don't even have to create a process, just optimize the process, make the process run more efficiently, make it
Yeah.
run faster. But a business process, if there are technical skills being used to eliminate uncertainty to create that process,
Hmm.
then it can very likely that it would qualify.
Interesting.
So process.
Interesting.
So just to throw it out there, some examples, like obviously software is a no-brainer.
Yes.
Manufacturing is a massive generator of credits. But there are these other applications from industrial applications, fabrication, and specialized fabrication of metals as an example. But
Sure.
even more one-off, right? We have a client who has you ever see those beer koozies? They look like a life
Yeah.
preserver.
Yeah.
Well, that's a product, and somebody had to design that product and manufacture it. They
I just
qualify.
thought
That's
of
one of our
someone
clients.
else as soon as you said that, and I'm meeting with
But
them
see how
next
silly
week.
that
I'm
is,
so
right? It's a beer
excited.
koozie.
Yes.
It's research and development. Wine
Yeah.
and just wine and spirits. You're using biology and fermentation. You have formulation. You're probably throwing out some batches. You're messing with flavors and shelf life. You know what I mean? And so people don't. And I'm not saying these are bread and butter opportunities, but they qualify. And some wineries have massive R&D tax credits. My
Awesome.
point is, you got to think outside the box to really capture these credits. And just remember, yeah, I mean, gosh, we had a client that brings these massive cranes in for construction. There's a lot of engineering, civil engineering. Can the soil, hold this crane? What is the right crane and the right sort of physics in order
Yeah.
to not just deliver the crane and set it up, but to get the job done? There's just so many different opportunities, and they're very specific to industries. So if your tax credit person doesn't know your industry,
Hmm.
doesn't understand all the complexities that go into it, then they're going to miss it probably. And what you need to remember is it's not just the people doing the work, it's the people supervising the work. It could be the CEO of the company. It could
Okay.
be, a manager of some sort. It's the technical people, the technicians, the engineers, the scientists, the techs. They don't need to have any of those titles. They could just be doing that sort of work. And then the people who support them. And we look at
Awesome.
all of their wages and try to allocate their wages to the projects they're working on. So long as we can show that those projects and their wages and time, there's a nexus, a connection to a process of the elimination of uncertainty in order to figure out how to
Yeah.
to deliver that process, that product, that service.
Interesting. I love
Does that make
that.
more sense now?
Yeah, well, it most certainly does. And I'm so glad we're speaking the same language because at the end of the day, it's the same thing with tax strategy and tax planning and tax stacking. We want to make sure we're looking at things outside of the box and marry what you're currently doing with the biggest tax benefits, paying less taxes, increasing cash flow, keeping more money in your pocket, so that you yourself are controlling where the money goes instead of putting it to the IRS charity, right?
Agreed.
And the IRS
Agreed.
is not a charity. So we want to make sure you have control back in your hands. What, just out of curiosity, what's one of your most favorite or one of the most lucrative R&D projects that you were involved in?
Goodness, goodness. There are a number, but sometimes we have entrepreneurs who develop really cool technology and they're losing money every year. They're losing money. They have no use for the credits. We're getting them credits. They're carrying the credits. Then all of a sudden, one day, somebody comes to buy their company. So we had a particular client been working for 5 years on a very novel cybersecurity solution. And they had massive credits, but they really didn't have a way to monetize and unlock them. And all of a sudden, they sold their company and they had a massive windfall. And we really were able to use all those credits for all those years that they had amassed to substantially offset the income, the capital gains from the sale of their stock. And
Awesome.
so not only did they have a massive windfall, but they had a tax efficient massive windfall. We were really happy for them.
That's
So that
awesome.
that
Yeah, it hit more than one bucket, right?
Absolutely.
That's
Yeah,
the
and I,
best.
one area I don't know if you're ready for this, but how do you really get benefit from these credits? I think is a good question to
Mhm.
ask. And the first thing is, of course, you can reduce your current year federal and state income tax if your
Mhm.
state has a credit. That's nice. So they're paying less taxes or no taxes this year at all. That's great.
Sure.
And so that's the first opportunity. But the next opportunity again is to go back and to do it. You can always look back at least 3 years. In California, you can look back 4 years as an example. Other states have different look back periods. If a company has never been profitable, then all tax years are open. They can go all the way back to day one and capture all the expenses and all the credits since they started their R&D and essentially since the inception of their business, which is a
Even if
huge
it
win.
was before the 3-year amendment period for the IRS?
Yes.
No
Yeah,
kidding.
there's case
See,
law that
I learned something new today too. I
yeah,
love
it's not in
that.
the code, but it's called Rev Rule, and there are cases on this where if a taxpayer's never paid taxes, all tax years are open, so they can go all the way back to day one and get all the
Oh
credits.
my gosh, it's a
Um,
no-brainer.
Yeah, and so then the next, I think the best thing though is to generate refunds from the prior years where they paid
Absolutely.
taxes. Effectively, they overpaid their taxes, so they amend, they generate refunds. Again, they can restate their financials and show higher retained earnings and or a lower burn rate. But other opportunities are like if a company hasn't paid taxes, if they're less than 5 years of performing R&D and under 5 million in gross receipts they can
Yes.
use the credits to offset their FICA, their payroll taxes, which is about 6.2% of their
Yep.
payroll.
Yep.
We can immediately start doing that on a timely filed return in the present quarter and going forward, which is really nice. And some states have refundable credits where, like in Arizona, there's up to 100,000 in refundable credits per year. So even though you never pay taxes to Arizona, if you're employing people and doing, and this is a few other states have this also, but if you're employing people and doing R&D within the state or have expenses within the state, it's not
Mhm.
even where you're located. But if you just
Right.
have people in Arizona, you can apply to Arizona to actually refund up to $100,000
Oh,
of your
wow.
based on your
I
on your
love that. And
credits.
that's really important because that goes into state nexus. You have nexus in a state, meaning you have the privilege of working in the
Yes.
state and the state has the privilege of collecting tax for you if you have employees in the state, revenue in the state, or property in the state. But you don't have to have all three. And some states only look at one of those factors, some look at two, some look at all three. And some
Right. All
don't
you
have
need
a
is
factor like Florida
right.
or
In this
Texas.
case, exactly. In this case, all you need is the employees in Arizona, or even
Yeah,
expenses.
I love that.
1099
That's a
in
great
Arizona
point.
would probably also qualify. So long as you have those expenses in the state, there's a fund, and you can apply for up to 100,000 in cash from the state to essentially offset your R&D
Ooh, what a
expenses.
gold nugget there. I love that. Jonathan, tell
Yeah.
me, right before we close the show, tell me what is the turnaround, right? Now it's January 2026, and people are getting in line to file their 2025 taxes. what would a realistic time frame be to, engage with you, do the credit research to see if you qualify. If you do, then actually do the credits and then provide all the information back to the CPA so they can file their taxes before all the deadlines? And is that even possible?
It is. Now is the time to do it. If you're a timely filer and you're a pass through, you have a 315 deadline, so you want to get started immediately. If you're a 415 deadline, you would also want to get
Oh, we
started.
would put everybody on extension. Just put them on
Yeah, no,
extension.
so yeah, I mean that's
So
the
you
thing,
have more
right? File an
time.
extension and you're good to go. Now you're at 915 and 1015. But the answer is that you need at least a month. You want to be safe. Give yourself 2 months. And it's not that it necessarily takes that long, but just the document collection process. A lot of clients, we're going back sometimes 5 or more years to collect tax returns, payroll information, general ledgers. And if you have all that stuff and you can instantly provide it, that's going to shorten the time quite a bit. But
Sure.
some companies, their data is across a few systems, and so it takes them a little while to call the data. They might have to call their old CPA or go into go find a file somewhere. But and then there's the actual conducting the work, and some of these
Yep.
providers that are doing the R&D tech, they're backed up. They can't just get on you immediately because you got to get in line to some, in some extent. And then typically there's technical interviews conducted where we're talking to folks and getting information and doing a lot of work on our side to prepare the tax studies. So give it at least a month, 6 weeks to be safe, 8 weeks to be conservative, depending on your provider. That said, it
Mhm.
is possible to get it done in 2 to 3 weeks if you go to the top of the list and your head's
Yeah.
down, done.
Well, obviously,
Um,
my clients are going to go to the top of the list, and people who are
of
listening to this
course,
podcast.
of
Of
course.
course, you have the red carpet rolled out in front of you. I have two more questions for you.
But
Number
I would
one,
I'd carve the one caveat just so I'm accurate here.
okay, no
So
red
if you're a
carpet.
really big company with a massive amount of R&D, you're doing it all year long in real time because you can't crunch it into a few weeks or a month, right?
Yeah, true.
Ford or Microsoft, right? They're just constantly doing it. So my answer was more on the small business side. If you're a medium-sized business and you have substantial R&D, you're going to want to allow a lot of time, or like I said, do it ongoing, a quarterly basis where you're prepping all this stuff and you're not leaving it to the last minute. I would want to make sure no one misses out. I would also just quickly append my answer earlier that
No,
Delaware, Michigan, and
no
Virginia have.
appending allowed. What are you appending here?
I'm just saying there's a lot of states that offer refundable credits, not just Arizona. So I want to throw that out there. And like I said,
Thank
about
you.
38 states have credits. So
Thank you.
I don't want to discourage people who are outside of the state of Arizona where I am, where I know it has a great refundable credit.
All right, now I know why you're there.
Yeah, exactly.
Jonathan, what is the best way for people to contact you? Obviously, let them know that they heard you on your Valued CPA podcast. But what is
Sure.
the best way for them to reach you?
Well, they
And I'll
can check
have
us
it
out
in the
on,
description notes as well.
yeah, they can check us out on our website at striketax.com. That's striketax.com. They can email me, John, Jon, at striketax.com.
Awesome.
And I'm happy to have them call me directly if it's appropriate to provide my direct line.
I love that. Thank you, thank you, thank you so much.
Yeah.
I think we're gonna have you
Well,
back on the show. It was a
can I give you my phone
pleasure.
number?
Go ahead, give it to the crowd. Give it to the
Yeah,
crowd.
four. Yeah, I mean, you can text me maybe if I don't recognize who you are. I might not jump on the call. You're welcome to text me. You're welcome to call me. Leave a voicemail if I don't get you, but it's 415-306-3252. And we love entrepreneurs, we love business owners, and we want to make them tax efficient, help them reinvest in their companies and in our economy, keep America, the strongest in R&D in the world, which is our goal,
Yeah.
and make the credit accessible to everybody. We don't charge up front to give an opinion. We don't charge up front for the work. We are a success-based only company. So meaning that our fee is only if you're successful and you're lowering your taxes or getting refunds, if you're getting credits, that's what triggers a fee for us. So we
Hmm.
really are on the same page with you.
Hmm.
We defend all of our work for the statute of limitations without charging our
That
clients.
was my next
So
question. What
yeah,
happens in audit situation?
the audits are just an inspection of the credit itself. It's not a full-blown audit of a taxpayer. They're
Hmm.
very infrequent, very rare. Only a few percent of these claims get reviewed by a tax authority. The states are a little bit more strict. But we defend all of our work. Otherwise, we refund any fee that we've received if we're not successful in defense. We're 99% successful, and the audit rates are very low. So there's no reason you shouldn't be taking this credit. It's a really great credit.
Awesome, 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 awesome. And I know that all the listeners and viewers out there, if you hung out this long, then you have also found the tax credits sexy. And there's very few things that are sexier than getting your money back dollar per dollar from the IRS, because then you can do anything with the money that you want instead of the IRS dictating to you. Remember, there are no stupid questions, and you don't know what you don't know until you ask. Thank you.
Thank you so much.